Welcome to International Securities Exchange's podcast series. Facilitated by renowned educators, ISE podcasts are intended to teach beginning as well as seasoned investors the ins and outs of trading. To find an updated list of podcasts, please visit www.ise.com/podcasts. Please be sure to listen to our important message following this episode regarding the risks of investing in exchange-traded options.
So where do we go from here? What are the potential paths from here? Well, let's start with this one. Global demand revives on an implicit weak dollar policy. It means the U.S. being a stimulator of last resort wants this game to get going again, wants that symbiotic relation to get going again, and that's part of what we've really seen over the last several months. The dollar's starting to weaken. The commodity dollar is going up in a big way. If this becomes the official policy and we can discern that, then this idea of continuing to buy the commodity dollars, Canada, Australia, New Zealand, South African rand, Brazilian real, and all those emerging market currencies that are linked tightly with commodities, they tend to move in a block, those are the things to buy. And that has been the thing, that has been what's been working, but we still don't have this. We have expectations of this that's driven all this. We don't have this yet, and we're not quite sure we're in the implicit weak dollar policy stage, but I'll tell you, given what the government's doing, we may be close. A little bit of that changed today on the analysis of what the Fed did. Second point, if Chinese demand comes alive for some reason we're not seeing, and again, we could be totally wrong. There could be a real upswing in Chinese domestic demand. What does that mean? It's a real threat to U.S. Treasuries. If their domestic demand increases, they can allow their local currency to increase in value. If they allow their local currency to increase in value, they don't have to buy as many treasuries to keep it pegged. And at that point, you can bet if China doesn't have to depend on the U.S. consumer and they can depend on domestic demand, this idea of them trashing the dollar reserve status to hurt the U.S. politically will really come out of the woodwork in a very, very big way. So if we see the domestic demand come alive in this cycle, you definitely want to get involved in the Chinese currency in some way to start getting that appreciation. You want to start buying the Asian bloc currencies because that would take the pressure off the Asian bloc. They're implicitly and explicitly suppressing their currency. If China takes the lid off of that, they would appreciate dramatically. On a purchasing power parity basis, most all the Asian bloc currencies long-term against the dollar are extremely undervalued, not to the extent of the Chinese currency, but very undervalued relative to the dollar. And the commodity currencies, we can continue to buy the commodity currencies because if their domestic demand comes alive, they're going to keep buying commodities. The other point of this, kind of the sub-point is, if domestic demand comes alive, does the U.S. come out of this crisis ahead of Europe or not? If they do, and the U.S. comes out of this crisis along with China, with a rebound in demand, probably be shorting euro and Swiss. And we would, if they don't, if the U.S. doesn't come out of this crisis and muddles through, and we just see a continued growth for some reason in the emerging markets powering themselves without the U.S., then we would definitely go along the euro because we think people would continue to run out of the dollar and the euro would be the mirror image of the dollar. The other point is, does China drop its capital controls? If they do, you're going to see a lot of this rebalancing pain that we're going through and a lot of tension China is creating in the world be eased dramatically. We don't think they will. But if they do, that will happen, and we definitely think that'd be a huge benefit for the global economy. And then we start to have to evaluate the currencies more in the fundamentals than just money flow in terms of these key themes. Do we have a false dawn here? Is this stimulus really front-end loaded? It isn't going to happen. Global demand isn't going to return. And everybody's going to be shaken out of this, these green shoots are going to turn into brown weeds, so to speak. If they do, we're buying U.S. dollars, we're selling the commodity dollars, we're selling the heck out of the emerging market currencies that have made a huge move against the U.S. dollar on this green shoot. And we're also selling the euro in a big way because these emerging market currencies affect the euro because of the euro banking exposure to the emerging market. Next point, no global demand and trade friction forces adjustment elsewhere. We're already seeing this. We're already seeing some real political problems between China and India going on in the background. India has already put up some barriers against Chinese goods. So this is something we're going to watch very, very closely because China doesn't want to take this adjustment domestically. If China's surplus is going up and they're not shipping goods to the U.S., that means the Asian bloc is taking over 100% of the adjustment, 100% plus of the adjustment or decline in exports from the West. They're forcing goods on Asia. If their surplus is going up in Europe and their exports to Europe are declining, their exports to the U.S. are declining, as we know, it means Asia's taking the brunt, and we're seeing the tensions building there. So if those tensions build and start to get out of hand, we start to see trade blocks. We're selling the commodity dollars, and we're buying the U.S. dollar in a big way on a major risk bid. If we see a real trade war developing and real trade frictions, you can bet a lot of money is going to run and hide back into the U.S. Treasury markets in a very, very big way. Now, if China emulates Japan and we have a major bubble collapse because of what they're doing here, we'll kind of have to evaluate that as it is, because we went back and looked at the Japanese yen when they went into that, really the bubble collapse, really around 1990, 1992 range and forward. Japanese yen really, kind of went sideways a bit, but the commodity currencies went down pretty dramatically for about a year and a half or more when the bubble collapsed in Japan. We think we're going to see the same thing. But in terms of the euro and U.S. dollar and the other currency classes, there really wasn't, in fact, the euro actually appreciated a little bit when Japan broke back in the 90s. So we'll really have to evaluate the currencies on an individual basis, probably, again, more in their fundamentals if we see some type of bubble collapse in China. I hope that wasn't too confusing to everybody and made some sense. I find it just a fascinating area, and as I said, I hope it wasn't too esoteric, but there's a lot of complicated economics here. But I think if you just get a general grasp of this, you can see a lot of risk and benefits out there in China. Steve, over to you.
Jack, I don't think it was too esoteric. I think it was very, very interesting. I'll speak for myself, but I'm sure the comments will come in. Very, very interesting. Not only how you show that how the money sort of flows, why it's flowing, but also I loved the last slide, your scenarios, because you're not saying that you have the answer, but you're giving people some plausible options that the way the world could work and what they could do. So I found it to be very, very interesting. Let me just go through the ISE-FX options, and I just threw up a chart of the Canadian dollar, just so you realize, as Jack was talking about, the COM dollars, when you're looking at the commodity currencies, well, you're seeing this is just a view of the U.S. dollar relative to the Canadian dollar. So you could have traded these options, and again, we'll go through a couple scenarios, but one of Jack's scenarios is that if things continue to go the way they've been going, well, the U.S. dollar will probably continue to sell off. So you see that down from, let's say, 128 down to about 114 or so. Well, then if you thought that was going to continue, you'd buy put options, because remember that ISE's product is based on the U.S. dollar. And I just wanted to remind everybody that you can always invert these, and I know a lot of you understand that, but you may trade the spot markets or look at that. You want to understand that if you invert it, you can quite simply get the reverse rate. So $1 in U.S. equals about $1.14, or like the ISE in 115 value. Let me go through and show you the idea of trading these. Is just if the dollar is increasing, and again, as Jack said, a risk bid, well, then you probably want to be buying some call options, because you'd be hiding in the U.S. dollar, and you can create different months and different strike prices. If you think that the world is going to continue like we've seen over the last 3 or 4 months, and then again, there are some other scenarios, like Jack was saying, that the Chinese economy is going to emerge, well, then the puts are probably going to make sense, because China will continue. There were some questions here about China stockpile, and there have been rumors that the Chinese have been doing a lot of stockpiling, buying commodities. So if you think that'll continue, the commodities will continue to increase in price, and you probably are going to want to buy put options on the ISE-FX options, specifically the AUX and CDD, the commodity currencies.
Thank you for listening to our podcast. To find more podcasts on options, stocks, alternative markets, and market data, please visit www.ise.com/podcast.